Are you considering buying a home or maybe just starting the journey of figuring out how much you can qualify for and thinking of using an FHA loan? Well, in today's video, we're going to dive into the FHA loan requirements for 2022. We're also going to talk about the pros and cons of using an FHA loan, and we're also going to address some of the commonly asked questions with regards to FHA so that you can make informed decisions whether or not FHA is the right loan for you. I want to start today's video by talking about the pros of using an FHA loan, some of the benefits, if you will. One of the biggest benefits of using an FHA loan is that they require a 3.5% down payment, only 3.5% down. So if you're purchasing a $100,000 home, that's only $3,500 down with regards to your down payment. $200,000, $7,000 down. $300,000, $10,500 down, and the numbers go up from there. Another benefit of using an FHA loan is that they allow credit scores as low as 500. In addition, they have very flexible guidelines, probably the most lenient of any loan program out there, way more lenient than that of conventional. So they allow you to have more monthly debt and actually qualify for more home with a lower down payment, with a lower credit score using that FHA loan. And in today's video, we're going to dive into that in a little bit more detail, help you understand what all of that means so that you can decide if FHA is the right loan for you. One thing I do want to get clear is FHA is not just for first-time homebuyers. It can be used by anyone. It can be used multiple times. You can use FHA as many times as you want when purchasing homes. You could have owned properties in the past. You could have owned investment properties. You know, one of the myths, if you will, out there is that FHA is just for first-time homebuyers or just for those with low credit scores. Not the case. You can have high credit scores and still benefit from FHA, and you can also benefit from FHA with a lower down payment, which we'll talk about here in just a moment. Now, in my experience, many people go to FHA because they either have lower credit scores or they have a lower down payment. And those are really two of the big benefits of actually using FHA because they do have that flexibility with regards to down payment and credit score. So let's take a minute here and talk about the down payment requirements that we mentioned earlier in the video. So they only require 3.5% down. But you have to have at least a 580 credit score in order to put that 3.5% down. If you have a 579 credit score or lower than 579, they require a 10% down payment. Anything above 580 only requires 3.5% down. And as I mentioned earlier, they go down as low as a 500 credit score. So 500 credit score to 579 requires a 10% down payment, 580 and above all the way up to 850 credit scores would require only a 3.5% down payment. Now, earlier in the video, you heard me mention some of the pros of using an FHA loan. Now, one of the cons, one of the downsides, if you will, with regards to FHA is how they do their mortgage insurance. Now, mortgage insurance is required on any loan when you put less than 20% down. So with FHA, even if you did put 20% down, you would still have mortgage insurance. But let's be honest, if you had 20% to put down, you probably aren't doing an FHA loan to start. But let's take a minute here and talk about what that actually means with regards to FHA. So as I mentioned a moment ago, they require that mortgage insurance with an FHA loan. Now, if you put 3.5% down, you know, your credit score is above that 580 credit score and you put only 3.5% down, that mortgage insurance is going to stay on the loan for the life of the loan. Now, that's one of the downsides of using an FHA loan, one of the cons, if you will. Whereas if you were using a conventional loan and you paid the principal balance down to where you had at least 20% equity, you could get that mortgage insurance taken off of your loan. Whereas FHA, if you pay down the loan and you have 30% equity in that property, you're still not in a position to have that mortgage insurance removed because it stays on the loan for the life of the loan. But FHA does have an instance where it falls off after year 11, and that's if you put 10% down up front with regards to your down payment. So if you put 10% down to start, after the 11th year, after you pay your mortgage payments for 11 straight years, that mortgage insurance will eventually fall off the loan. Now, a lot of people reach out and ask, well, you know, I didn't put the 10% down initially, but I have that equity in my property now. I have that 10% down. Will it fall off after year 11? At this point, the answer is no. It only falls off your FHA loan when you put the initial 10% down payment up front and you pay your payments for 11 straight years, at which point the mortgage insurance would fall off that loan. Now, I often get people reaching out to me asking questions about how mortgage insurance works on FHA loans. Stay tuned to the end of the video where I discuss that in more detail, give you some insight on how mortgage insurance works so that you know exactly how to calculate it when you're using an FHA loan. Now, one of the other downsides of using an FHA loan is they only allow them on primary residences, your principal residence where you plan to live. And if you're planning on living in the property, then it's not a big deal. But if you're looking to buy an investment property, FHA won't allow you to purchase it for investment purposes. But here's one of the cool things. A lot of talk out there at the moment about house hacking. Can I buy a property using an FHA loan and eventually turn it into a rental after the first year? And the answer is yes. You can live in that property as your primary residence for the first year, and after that year is over, you can actually turn that property into an investment, go out and purchase another property using an FHA loan, and essentially do the same thing. Now, while FHA only allows you to use their loan for a principal residence or a primary residence, you can actually purchase units with an FHA loan, which means that you can purchase a property, live in one of the units, and rent the other units out. Now, I get people asking me all the time, what is a unit? I don't understand. Is it multiple properties on the same site? Is it like an apartment building? A unit, if you will, is typically a door, right? So if you have a building that has two doors, if you will, there's two houses, so to speak, as part of the same building, that would be two units. In some cases, it might look like a small apartment building, and there might be four doors. And when I say doors, I'm talking front doors, right, where you would initially walk through that property. And so in that case, that would be a 4-unit property. And FHA allows you to purchase up to 4 units using an FHA loan, as long as you plan to occupy at least one of those units as your primary residence, which means you can rent the other 3 out. And after the first year goes by, you could actually turn the other one into a rental as well and go purchase again using an FHA loan. So that is one of the huge benefits of using FHA, but also kind of a downside if you were just planning on making that property an investment from the start. So just keep that in mind. There are opportunities out there using FHA that allow you to house hack, if you will, and give you that opportunity to buy a property and eventually turn it into a rental. And with that said, they do only require 3.5% down, even when purchasing units. So even if you bought 4 units, all you have to put is 3.5% down towards the down payment, which is a huge benefit when purchasing a home. Now, at the same time, there are some other requirements that FHA has with regards to purchasing property. And that is, if you plan to purchase a condo, that condo needs to be approved by FHA. It needs to be an FHA-approved condo in order for FHA to allow you to use their loan. And not all condos out there are FHA approved. Depending on where you are in the country, more of them might be approved than not. But one thing you can do is actually check the link in the description below. You can go in there and find out if the condo complex you're interested in is actually FHA approved. Now keep in mind, if it's not FHA approved, there are ways to get it approved if the community actually meets certain qualifications. I'm not going to get into that in this video, but just keep in mind, just because it's not FHA approved doesn't mean that there's not an opportunity to get it approved, but it may require some work in order to do it. Now, if you're going through this video wondering, who am I to talk about FHA loans? My name is Jeb Smith. I'm a real estate broker here in Southern California. I was actually a mortgage broker for over 10 years, did a lot of FHA loans, still follow them today, still, guide clients with regards to loans, although I don't do them. So do me a favor, if you find any value in this content at all, give me a thumbs up, share it with somebody that that might be looking, someone that may be looking for more information on FHA, because the goal here with this video is just to provide you unbiased information, help guide you through that process so that you can make, the best decision when choosing the loan for you. Now, while we're talking about loans, I often get people reaching out to me asking me, how do I apply for an FHA loan? So what I'm going to do is I'm going to put a link in the description below where you can go and find a mortgage broker that works in your area, that has a great reputation, that has experience, that knows what they're doing, so that they can guide you through that process, answer your questions, go over the qualifications with you, run your credit, run you through that process, and get you approved. Now, I have people asking me all the time, should I call somebody online? Should I go into my local bank? I would say no. You need to work with a mortgage broker because brokers are typically more flexible on their guidelines. They have several banks they can send your loan to. Whereas if you just go into a bank, some banks don't do FHA loans at all, and some have overlays on their programs. Now, what is an overlay? An overlay is essentially a guideline on top of a guideline. And what I mean by that is that FHA has loan requirements where they allow you to have as low as a 500 credit score, putting 10% down, or a 580 credit score, putting 3.5% down, as we mentioned earlier. But if you were to go into your local bank, if you will, they might have a guideline, an overlay on top of that guideline that says, instead of having a 500 credit score for 10% down, we need you to have at least a 600 credit score to put that 10% down. Or in the case of the 580 with 3.5% down, they might say you need a 640 credit score. So they have this overlay on the program that FHA doesn't require, but the bank requires, that they've set that in place so that the loans that they're taking in are higher quality, if you will, so that when they go to sell them on the secondary market, they know they're not going to have any issues selling that loan. And so they put these overlays on there. So if you want to find a mortgage broker, a professional that may or may not have these guidelines, or if anything, they have more options to choose from. If they do run into a bank that has those overlays, they have other options for you. And brokers can typically, get you past those overlays and usually have more lenient guidelines. So if you are looking to get approved, want to talk to a professional, click that link in the description below. Now let's get back to talking about some of the additional FHA loan requirements that you need to know if you're planning on considering an FHA loan to purchase a property. FHA loans do have loan limit restrictions, which means they won't lend more than a certain amount of money in certain areas across the country. Now, if you're in one of the low cost areas, they won't lend more than $356,000, $362,000 on a single unit. Now, if you're in a higher cost area, that number is $822,375. So there's a big disparity there. And you're probably looking at this going, well, how do I figure out if I'm in a low cost area or a high cost area? Well, I'm going to put a link in the description below where you can actually go and check your county loan limits, and they can tell you exactly the max loan amounts in that county. And as I mentioned earlier, FHA does allow you to purchase units. And with units, each unit that you add, they allow a higher loan limit in that area. So 2 units, 3 units, and 4 units allows you to qualify for more home, again, only putting that 3.5% down. Now, I've thrown these numbers on the screen for the low cost area as well as the high cost area. Now, these numbers can change. If they do change, I will put them in the description below. But at the making of this video, these are the current numbers. Now, when people hear about loan limits, they often reach out saying, is there a limit on how much income I can make because I'm using only 3.5% down? And the answer is no. You can make $1 million a year and still qualify for an FHA loan. You can still use an FHA loan regardless of how much income you make. And on the other side, there's not a minimum income either. As long as you can meet the debt to income requirements and still purchase the amount of property that you're looking to purchase in your area, then income doesn't really matter. Income is only there to tell you how much you can qualify for based on your debt, which is going to take me into my next loan requirement. FHA typically has a max debt to income ratio of about 57%. Which means that you can qualify for more home using an FHA loan than you can that of conventional. Because conventional, the max guidelines are somewhere around 48, 49% on the back end, whereas FHA allows that 57% debt to income ratio that I mentioned earlier. Now, if you're asking, well, what is debt to income ratio? What does that even mean? Well, basically what they do is they take all of your debts, your monthly car payments, your credit cards, student loan payments, they add those together, and then they also add in your housing expenses, your proposed housing expenses. So they're going to factor in your new mortgage payment that you're trying to qualify for, the property taxes, the mortgage insurance, the homeowner's insurance. If the property has an HOA, they're going to add all of that up, plus your monthly debts, and then they're going to divide that by your monthly gross income. So if you make $120,000 a year, that's $10,000 per month. So they're going to take your monthly debts, as I mentioned earlier, and they're going to divide that by your monthly income, in this case $10,000, which is going to tell you your debt to income ratio. And FHA doesn't allow you to have higher than a 57%. Now, the next thing that FHA requires is steady income and steady employment. Now, that's going to be required really on any type of loan that you get, regardless of whether you're using conventional, you're using a VA loan, or you're using an FHA loan. They want to see that you have steady income and steady employment. And typically what they want to see is 2 years on the same type of work, in the same line of work, the same type of job. Doesn't have to be the same job, right? You can transfer from employer to employer as long as the line of work is similar. So if you're a server at a restaurant and you work at, say, Outback for a year, and then you decide to move to Chili's, and you work there for a year, that's the same type of work. So that your income would be steady in that case. But what you can't have is say that you're that server at Outback for a year and then you decide to leave and go be a real estate agent where you're self-employed. That's not the same line of work. So you might have issues qualifying in that case. And another thing you need to have is steady income. You can't have income that's, fluctuating all over the place. Typically what you want to have is income that's pretty much the same year over year, going up a little bit year over year. And if it's declining, it's not declining by much, maybe a small percentage, but income and employment need to be steady. Now, earlier in the video, I did mention some of the pros, and throughout the video, I've mentioned some of the cons, but I did want to do a quick recap here just to help you understand, pros versus cons. Some of the pros of FHA are, the minimal down payment, the lower credit score requirements. They also more lenient guidelines, right? Those are the main things that are the pros of FHA. Some of the downsides, if you will, only allowed to be your primary residence with regards to a purchase. Now you can purchase investment using units, as I mentioned earlier, but they do require, that condos are FHA approved. Another downside there. Another one, mortgage insurance does stay on the loan for the life of the loan unless you put 10% down, in which case it does fall off after the 11th year. And also we talked about the loan limit restrictions. So depending on where you are in the country, you might be capped on how much home you can actually purchase using an FHA loan. And lastly, one thing we haven't talked about is one of the downsides of using FHA is the market that we're in at the moment. It can be difficult to get an FHA loan approved, not from a qualification standpoint, but get a seller to accept your offer in this market using FHA. And you might be saying, why? Why is it difficult to get an FHA loan accepted versus that of a conventional offer? We're both approved, we both met requirements. Why? Because when a seller looks at offers, say you're in a multiple offer situation, you've got somebody that's putting 10% down and you have someone putting 3.5% down. The perception is the person putting the larger amount down is more qualified. And that doesn't necessarily have to be true. It's just the perception from the seller side. And there are some things that you can do to overcome that. If you're working with a professional real estate agent out there, professional can help guide you through writing the contract to maybe offset some of the things, some of the negative connotations of using an FHA loan. And if you need an experienced real estate agent out there, do me a favor, click that link in the description below. I can happily refer you to one as well. Just as I mentioned a mortgage professional earlier, the same link below gets you in touch with both of them. So if you do need a pro, just let me know and I'll make that referral for you. But an experienced real estate agent can help guide you through the process. They can work with your lender to help your lender help the seller understand. But, in this market, FHA loans are frowned upon in some markets. So just understand, just because you're approved and you're using FHA doesn't necessarily mean it's going to be a walk in the park when coming to get your offer accepted. It is one of the downsides in this environment because of how competitive it is. FHA loans are a little more difficult to get accepted because of the connotation out there, the misunderstanding of what an FHA loan actually is. So hopefully this video has been helpful in helping you understand what you need in order to qualify for an FHA loan. Now, earlier in the video, I did mention we would talk about how to calculate mortgage insurance. What I'm going to do is throw you to a video here where I talk about mortgage insurance in more detail. And I also link to a video here where I talk about FHA versus conventional so you can get an idea of whether FHA is the right fit for you. Maybe conventional is. But anyway, check out those videos and let me know your thoughts in the comments below. But for now, I appreciate you taking the time to watch. I appreciate all the support. Hope to see you again soon. Have a great day. Bye-bye.